everyone's got an opinion about money, especially if they're on TV or maybe have a book deal they're trying to promote. And some of that advice is pretty useful, but some of it sounds better on stage or on TV than actually applying it to life. So today we're going to break down some of the more popular people in the industry and some of the advice they provided. Welcome into Perfect Game Retirement. Ben George with Ryan Ledden at Black Oak Asset Management. Ryan, there's plenty of opinions out there. Look, we're providing some as well here, but there's some big names, right, that have thoughts on money, and everybody kind of approaches it differently. And I think today's conversation is important because we're going to talk about some of these that are out there that might seem a little controversial, or maybe, hey, even popular to some people. But I think the biggest kind of thing to kind of start with here is that not every advice is going to apply to everyone out there, right?
Yeah, like you said, sometimes it's clickbait if it's online or sales tickets or whatever. But some of it could be some legit advice. It may be extreme. It may be very different. It may be against the grain. But some may apply, and some may just be ludicrous and doesn't apply at all. At least in my opinion. Yeah,
so we're going to take you through that today. So what I'm going to do is I'm going to provide the information or the take that somebody provided, and then have you kind of just give your thoughts on if you agree, disagree, maybe kind of what we would change from that. So I'm going to start with the Rich Dad, Poor Dad author, Robert Kiyosaki. He says, now people shouldn't work for a company and just save to their retirement plans. Instead, they should be launching their own startup or buy gold, silver, and Bitcoin, or all of the above. So it seems like the traditional method is out the window in his mind, and you got to kind of be a little bit more aggressive. What do you think?
It's not to be non-committal in the first one. It really does depend. I don't necessarily disagree with what he is saying. Obviously, Robert Kiyosaki has given a lot of great advice and written a lot of good books in his day. So not going to say he's wrong, but it's a different way. Definitely starting your own company. I'm all about that. That's essentially what I've done. So I'm for that. Do I think the investments, of course, I'm an advisor. Do I think the investments need to be spread around more than just precious metals and Bitcoin? I mean, I do. Not saying any one of those things, because if you look at the recent returns of gold and silver and Bitcoin, they've been good. They've been really good, but they're super volatile. I mean, super volatile. So you put in any of these investments into a risk meter, if you will, and it's the highest it can go. So that's where we just have to educate people and tell people these things are super volatile. You may hit it. You may hit it. You may strike it rich or strike gold, no pun intended, but you could lose it as well. So it's super volatile. I'm not saying it's not, and just like starting your own business is super volatile. I mean, you read all the stats from the SBA and all the studies that they have, and it shows the success rate of small businesses after 1 year, 3 years, 5 years, 10 years. It's low. So not saying you can't be successful in any one of those, but it's kind of the risk reward, just like investments. It's the risk reward. You could risk it and do really well, or you could risk it and not do very well. So don't disagree, but it's not a conventional way for sure.
And I think, to me, when I kind of read this and hear this, to me, it just sounds like, hey, you can't just follow the path that's always worked necessarily, right? Or just assume that's going to work, because so much has changed with the current landscape we're in.
Yeah, and no one has a crystal ball to see where this stuff or the future is going to go, whether it's the market or jobs or industry. And of course, just the term AI it's so I feel like it's so old already. Just saying those, but obviously that's going to constantly change. So there's advice out there that sometimes we can't foresee what's going to happen in the future, because there could be so much change that we don't even know yet.
Yeah, no doubt. All right, what about the host of Women in Money, Suze Orman, a very popular figure? She recently suggested that retirees set aside 3 to 5 years worth of living expenses in a just-in-case bank account to protect against stock market losses and crashes. So that seems like a lot more than I would typically hear someone provide guidance for.
Yeah, that is a lot. Some people don't have the ability to save that much in cash, that they're trying to save so much in the market so that potentially this money would grow long term. So 3 to 5 years, I think, is a lot. If you have the means and capacity to do it, I'm not against it. I do think it's a good bit more. Would I do it? No. I'm more on the 1 year at least, especially people who are in retirement. That way, if there is a pullback in the market and you're still taking income on a monthly basis, you can pull from those quote unquote cash reserves or those safer investments. So I think it's a constant adjustment, because eventually, or hopefully, that market will recover. And then when it recovers really well, again, whether that's the following year, 3 years, 10 years, whatever, you have the ability to move those funds back out to be more risky, and then into cash if it does really well. So I'm more of the 1 year person, 3 to 5. Hey, more power to you if you have the ability to do that and then invest on top of that to keep up with inflation. Then I have no problem with it. Again, I'm not disagreeing. I think it's just a little high.
Yeah, and a lot of those conversations you should have with an advisor about, how much you need to have, what your comfort level is. Some of this emotional, right? And that's okay. Kevin O'Leary, everybody knows Mr. Wonderful, right, from the Shark Tank. He insists that if you don't know your net worth at all times, you're being irresponsible with your money, and he promotes constant tracking, optimization, and performance measurement. So I know, Ryan, we talk about, hey, you don't need to be looking at your bank account every day, but should you have a good feel for what your net worth is day to day?
I think this is one of the most overlooked stats that people should keep on themselves, because it shows progress, hopefully progress, or it shows you going backwards. Now, needing to know that all the time, I think that is a little much. But knowing your net worth, hey, put your assets out and your liabilities and see where you're at. So a net worth is something that more people should know, and you may even surprise yourself. The more you keep track of it, you may be like, wow, from a net worth perspective, I'm a millionaire, and you may not even know it. Now, again, is there $1 million maybe in your checking account? No, probably not. But there's ways to build that net worth. And as you pay your debts off and then increase your savings based off of your savings or the market, then there may be a real increase from year to year. So we kind of use that as a measurement to motivate yourself to maybe be that millionaire or decamillionaire, whatever that may be. But knowing your net worth is important. Knowing it at all times, I think, is a bit much.
Yeah, and to me, Kevin O'Leary's got so many investments and has his hand in so many different things. His net worth probably swings quite a bit day to day, where most of us, it's going to be very incremental.
That's right. Yeah, his sheet's going to look a little different than most.
Yeah. All right. What about the star of Netflix, How to Get Rich? He's been renting his home for 20 years, and not because he can't afford to buy. His stance is that buying a home is a bad investment, and that renting can be a better financial decision than buying, if that difference is then invested. So a little bit different approach, right? But what do you think?
Different approach. I think to call real estate or buying a home a bad investment, there would be a ton of people that would say, no, that is incorrect. But I don't like the word bad or good. That it may just work for him, and that's fine. If he wants to rent and not have the mortgage expense and then the upkeep, and because obviously there's a lot more to expenses from a house other than the mortgage, taxes, and insurance. You have the upkeep of a home, and that can get very expensive, especially the big major stuff. So I see where they're coming from, but it's a real estate, historically speaking, has been a great hedge against inflation, and it has done really well. Are there corrections in the real estate market? Yeah, we know that. We've seen it in recent history. So it's not a bad thing. It just works for him. Now, the discipline part is investing the difference. So this kind of goes back to, buy term, invest the difference, which makes complete sense. But some people don't have the discipline to invest the difference between a term and a permanent policy. In this case, he's using real estate, take out the insurance piece, and he's putting in real estate. So it makes sense for him. Again, I like real estate, so I would have to disagree, but I don't think it's a bad play. It just works for him.
All right, we're talking about some financial advice, maybe a little controversial, some of it popular, but let's go to Grant Cardone. He frequently argues that using as much leverage as possible is the fastest path to wealth, especially in real estate. He downplays risk. He promotes aggressive borrowing and frames caution as playing small. So, look, I know, everybody's a little bit different their approach, Ryan, but you think it's safe or smart to be this aggressive as he's promoting?
Me personally, no, leveraging that much, but I've heard plenty of people say this. I've been to conferences where I've heard people say this very thing. So obviously, again, it's work. There's a reoccurring theme here. It's work for those individuals. Is it blanket advice for everybody? No, I think you really need to know what you are doing. And he pops up on my social media all the time and trying to sell things, which great, good for him. That's what he does. But you really need to know what you're doing. And that's kind of what he's selling on some of these online seminars and conferences, that he's kind of giving you the playbook to do that, which again, I'm not knocking it, because I've never been to one. I've never seen what he actually does. I know the big picture of what he actually does. So if you know what you're doing, great. I think it's a huge risk, just like Robert Kiyosaki buying Bitcoin and silver and precious metals and starting your own business. So that's a risk as well. But again, not a path I would take.
All right, let's go to Dave Ramsey. You're very familiar with the radio show personality, and he's never shy about his opinions as well, right? He's actually moving away from that common rule of thumb of the 4% withdrawal rate. He's advocating for 8% annual withdrawals in retirement for those people that are investing 100% in stocks. And his whole idea is that, look, if the S&P 500 yields a 10% rate of return, the money should last you through retirement. So what do you make of this one?
Yeah, I mean, look at history and you look at the S&P and what it's returned. And so, yeah, it does make sense. But if you just see a lot of people in our industry run these reports and the sequence of returns risk, and if you take that much out, that it's just as a advisor and a fiduciary, it would be tough to fully recommend everybody to be fully into the market and take an 8% withdrawal rate and for them to sleep well at night. That may work for some people. It's 1000% not going to work for everyone. Some people just don't trust the market, and it's not my job to talk people into doing that. Now, again, it's my job to educate and to show what it historically done. But again, telling people to put 100% of their money in there and take an 8% withdrawal rate each year, that's a big liability as an advisor, which Dave Ramsey's not. He gives a ton of great advice. Respect the man. He's obviously built an empire, which I was a small part of for a while, but not anymore. And it's his opinion, but I disagree. That's a tough ask to ask all your clients to put 100% of their money into the market and then take a high withdrawal rate.
Yeah. All right. Caleb Hammer, you might have seen him cross in your social media feed. He's built a massive audience by dissecting people's spending habits publicly. He says most people don't have a money problem, they have a behavior problem. And he's concluded that, look, math isn't usually the issue, it's discipline. This seems like something you might agree with.
1000%. I do. It is, I think this is why, AI is going to replace a lot, but in our industry, I mean, never say never, but there's so much emotion and behavior when it comes to people's money. So I think having the human element in there and building in that discipline, this is the one I 100% agree with, because it's a principle. It's not like this is a cool strategy. This is kind of a principle of human behavior, and no matter what you do, but especially with your money and your finances. So I'm on board with this one.
All right, last one, Elon Musk. We know Elon, everybody's very familiar, and he's very involved with robotics and AI. He predicts that as we continue advancing AI, energy, robotics, they're going to generate such an abundance of resources for everyone that retirement savings are going to become irrelevant. On a recent podcast, he said, don't worry about squirreling money away for retirement in 10 or 20 years. It won't matter. So I guess that's maybe a great prediction if it comes true, Ryan, but I don't know that I'd be pretty comfortable relying on that and just not doing any retirement savings in the meantime.
Yeah, it's hard to even wrap my brain around what he is saying there. Now, again, he's changed the world in many ways, and he will probably continue to do so. But it's hard to wrap my brain around not saving money for a rainy day down the road, or that goal of retirement one day. And maybe he's going to change the world so much that there's an abundance everywhere. But one that's never happened, and never say never, but I'm betting against that. Not betting against him, but I'm betting against that statement. That, to me, I can't wrap my brain around that.
Yeah. Well, there's some really good, advice and just some ideas out there, Ryan. But I know that a lot of this can be entertaining, motivating even, and occasionally can be a little bit unhinged, but you want to know what advice fits to your life and circumstances, and ignore the other stuff, Ryan. But that's difficult to do on your own. It's kind of the role you play, right? Is to help people sort through the noise and figure out what path they need to go down.
Yeah, because there's noise everywhere. I mean, there's clickbait everywhere. Google search anything, Chat GPT anything. It's just making headway of what is the right solution for you. And yeah, I think that's where working with an advisor, whether it's us or anyone out there, to find a good fit with is just wading through all these options, because there are a ton. These are just, I think we did like 7 or 8. This is just a microcosm of how many different ways you can do it.
Yeah, absolutely. Well, you can learn more by going to blackoakam.com, but you can also book a time to talk with Ryan and start talking through some things on your mind, some concerns you might have, start talking about your plan, where you want to go, and do all that by starting at speakwithryan.com. You can schedule that complimentary consultation right there. Again, speakwithryan.com. All right, that'll do it for this episode of Perfect Game Retirement. Appreciate you being a part of the show. If you haven't subscribed, please do that as well on YouTube. Over 1,000 subscribers, Ryan. Congratulations. Good stuff. I know you're pretty excited about that.
Yeah, that was a little mental goal of mine. Now it's just like, let's go to 2.
Yeah, exactly. Well, help us get there. Just hit subscribe. That's all we ask. We appreciate you watching. We'll talk to you again soon.